Good morning, everyone. Thank you so much for joining us. I'm Mark Phillips, and I'm here with Harvested Financial to talk about the markets. So today is Tuesday, February 23rd, and we are looking at what's going on out there right now. And so far, it looks like a little bit of some red in the markets. People have been concerned about some of the sell-off that we're seeing. We're seeing a lot of the major indices coming off this morning. We can see that SPY is down $3.42. We can see that IWM is down $5. The Qs are down almost $7. The VIX is up only $1.67. We've actually seen some relatively elevated VIX levels over the last couple days and weeks. We spoke about that on Friday. It's not that much of a surprise to see the VIX not pop as much as maybe would have been expected. Bitcoin, huge story out there. Last night we saw a ton of volatility in the name, traded down into the 44s, 45s, came off quite a bit, settling right now at around 48,221. This asset has been moving quite a bit. So some really interesting things going on in those markets too. But overall, what I would say is the markets need to go both down and go up. We're sitting on huge gains across many of these indices over the last days, months, and weeks. It's important to keep a lot of these things in perspective. Last night we tweeted out something about what the average vol of some of these names are and how much you can expect that to move. So even with SPY trading around an 18 vol, that's still going to move a little over 1% a day. With Bitcoin trading in the 110 vols, that's 7% a day. So you're really going to have to expect to see some medium degrees of moves with volatility. That's just the name of the game, and that's why we trade options. So what I want to look at today is how we can use the power of options to help manage some of this volatility. And a name like Tesla is a perfect example of that. So Tesla's had a choppy year so far. So how can we reduce the risk of a long position? Well, what I want to do is I want to bring up a collar strategy. But before that, let's talk about some of the headlines that are happening in Tesla right now, because it's important to put some of this in context. One of the things people are saying is, what is the alignment of Tesla with the Bitcoin? So, of course, that was a big deal when Tesla bought $1.5 billion of Bitcoin. What feels like ages ago was only in reality a couple weeks ago. It seems like the stock has been totally crushed since then. To give you a quick update on where we are this morning, we are down $72 or almost 10%. Tesla's trading around 644. So that is down. Certainly some red for investors, but compared to long-term valuations, we're only down about 7% year to date. That actually might be a little bit more at this level, but what's significant, and I think what feels like pain to people, is the fact that we're 25% off the all-time highs. So it felt like Elon bought Bitcoin near Tesla all-time highs, and all of a sudden the stock has just gone down since. Well, it's hard to say that that's totally correlated to the Bitcoin price. With the size of their balance sheet compared to a 1.5 billion allocation, it's just not going to be significant. That's not what's driving this. What's driving some of the movement here is that it is a high vol stock, is that we have, the front month is trading around 120 vol. I'm looking at the back months, even the March is trading around an 80 vol. So some of those calculations I mentioned before, let me run through really quickly how I think about them. So if it's an 83 vol, I take 83 and divide that by 16, which is about the square root of 252, and I get 5.18. That's 5.18% a day that we expect Tesla to move. So if this is a $630 stock, I'm going to multiply 5.18% by 632. Wow, the stock keeps coming off. We're down to $80 now. That's a $32 move every day. That's not an 11% move every day, but that's a reasonable move every day. So volatility is a feature and not a bug. And it's really important that people remember that when they're investing. Volatility is how people earn their long-term returns. So I mentioned, maybe Elon's tweeting too much about Bitcoin. Don't think that's the question. I think there's a lot of red for people that are feeling that gut-wrenching pain of seeing their valuations drop. These valuations soared and we felt great, but we also are going to have to see them on the downside. One of the last sort of myths that I want to dispel is the idea that maybe this is a victim of rotation. Maybe the tech trade is, gotten too inflated. Maybe that, people are leaning long Tesla and forced to liquidate because they've got all kinds of other assets. Maybe that might be the case for ARK. That is one of the names out there that is known to be a long holder and seen as relatively leveraged to the space. Maybe there is some play there. Maybe there is some rotation around different names, but I think that's hard to totally pin this morning's action on. Perhaps this is a bit of an overreaction, but volatility is a feature and not a bug. However, that's particularly true for long-term investors. And if you don't necessarily want to bear that volatility, withstand that, perhaps you were very happy with the gains that you had, and you want to lock those in, a collar strategy is perfect for doing that. And at Harvested Financial, option strategies are how we manage volatility. Whether it's to accentuate that or whether it's to dampen that, an option strategy overlain on your stock position will give you a defined return structure that suits your needs. So I'm going to pull up my Tesla options chain, and we can start looking through some of this. So let me just adjust where I'm at. And I tried to blow up the pictures for everyone here so you could read these options montages a little better. I know the screen, the font sizes were a little bit crushed there. So what I'm looking at here, Tesla's trading around 640. We want to think about a collar strategy. So I'm actually going to do, as I like to do, a slight different flavor on that collar strategy. And if we're going to look out, to an April serial expiration, important to trade on some of these serial expirations. Liquidity is always going to be the best. Liquidity always matters for execution. Particularly on a day like this, you're going to see a lot of choppiness in trying to get filled because not only are the inputs moving across the stock dimension, across the volatility dimension, but people are going to widen their markets as a function of that. So wider or more volatile inputs means wider markets. One easy way to think about the width of a market is going to be the participants' pricing of the certainty of that theoretical value. If they're highly certain because those inputs aren't moving around that much, they can tighten that market up quite a bit. If those inputs are moving around quite a bit, we have a high vol, or we have a lot of stock price action, we're going to see those markets widen out a little bit. So if I want to get protection around the 600 level, remember we're trading around 630 right now, going out to April, that 600 put is an expensive put. That's a $58, $59 put right now. So that's going to be quite a bit of cash outlay that we need to put out. And we're only getting around 5% protection on the downside. So $30 down to 600. We're getting about 5% protection on the downside for almost $60. Well, the traditional collar would say we need to find a call that we need to sell to offset that. So I would sell a $60 call, which conveniently is symmetrically $30 over the current stock price and around the 660 level. So here we have about an even collar. Actually, this one's going to be slightly a credit depending on where you get executed. There are always some quirks that you might not necessarily find the exact zero cost, but right here, 600, 660, lock in our range for the Tesla stock price between now and April 16th expiration, 51 days out. If you don't want to sell that 660 call, we can think about doing something else. And I'm actually just going to have to pull up the bigger font sizes. It can be a little bit harder to find things in here. So, still going to go for this 600 in April. So I'm still in April. I got this 600 put. It's gone up $2 since we first started talking about it. But if I want to get my $60 some other way, what I might do is I might go to the March 19th. So I might go halfway out. It's conveniently about 23 days out. And there's another serial expiration, another great opportunity for liquidity. But I now know I have two opportunities to sell calls. I'll sell the March 19th call, and then I'll sell another call that I can collect $30 once my March 19th rolls off. So where can I get $30 of exposure up to March 19th? Well, you get a lot more exposure here because it's a shorter dated option. Options are going to be worth less, so you can get much more upside movement. Instead of selling that 660 level, we can sell the 690 level in March. So we give ourselves almost $65 worth of upside here with only $30 of protection on the downside. These numbers are constantly in flux because I see stocks already $8 off from where we originally started. But conceptually, by selling a shorter dated call twice to finance that longer dated put, you're able to give yourself more upside protection. I shouldn't say protection, but more upside room to run. So using a split month strategy here allows you to finance this collar in a lot of different ways. Collars are great for these kinds of stock scenarios where you can see a 12 or 13% drop in a given day. $90 is a lot of money to lose off a single share price. 13% is a big drop. It's bigger than the volatility we talked about. And while I still do believe that volatility is a feature, not a bug, and it is not necessarily normally distributed, i.e., that variance is not going to be the same across different days, it is still something worth considering protection on. So strategies like this are great to implement systematically. You wouldn't necessarily want to just go out to April and do the March and just do this one-off. That helps you for the next 51 days, but to manage this position over time is something that Harvested Financial excels at, and it's what we've built our strategy execution engine to deliver. Setting up trades like this, systematically staying exposed to the features of options markets and using them to manage stock positions is one of the best way to enhance returns that deliver exactly what you are expecting. So we're talking about option strategies every morning here on the Daily Bread, 8:35 Central, 9:35 Eastern. Make sure you hit the subscribe button and tune in for more ideas about how to use options to benefit your portfolios. You can also check us out on Twitter at harvested_DAFE because we believe derivatives are for everyone and they can do fantastic things like this for your stock position. So thanks so much for joining us. I appreciate everyone tuning in.